Hello student, this is Pallad Darbari, your host, and you are watching Pallad Darbari classes. In this video, we will discuss balance of payment. This is the first volume of the chapter, balance of payment. Now let us see the components of balance of payment. Listen, in the case of balance of payment, two important components are there. Number one, current account components, and number two, capital account components. Current account components of balance of payment is that account which maintains the record of import and export of goods, services, as well as unilateral transfers. So what is current account of balance of payment? The transaction related with the import and export of goods, services, and the unilateral transfer is called current account of BOP. Let us see the capital account of the BOP. Capital account of BOP Capital account refers to that account of BOP which records all the transactions that causes a change in the status of assets and liabilities of the government or any of the residents of a country. In a very simple word, we can say current account is related with a short period which has no effect on the asset and liability of the government, whereas capital account transactions are the transaction which has an impact on the assets and liability of the government. Now let us see the components of current account transaction. In the case of current account transaction, the first component is visible items. Second component, that is invisible items. Third components, unilateral transfer, and the fourth component is income. So in the case of current account, we are having four components: visible trade, invisible trade, unilateral transfer, and income. Let us see and discuss all these components one by one. The first component, as I told you, is the export and import of goods. The transactions of a country in the form of export and import of goods is recorded in the current account of BOP. The BOP, the first item is export and import of goods. This record of export and import of goods is also called balance of visible trade. What it is being called? Balance of visible trade, because it is related with the import and export of goods which are visible. The export of goods is recorded as the positive items in the country. Why? Because it brings the inflow of the foreign currency in the country. On the other hand, import of goods are recorded as negative items in the current account of BOP. Why? Because it results in the outflow of foreign currency from the country. Important thing, the net balance, that is export minus import, is called balance of trade. I hope the first component is clear, that is export and import of goods. The second component is export and import of services. The record of export and import of services is also called balance of invisible trade. Why? Because here the import and export of services is going on which is not visible. So it is called balance of invisible trade. And it is just like similar to the export and import of goods. Remember one thing, the export of services will be recorded as the positive item because it brings foreign currency, and the import of services will be considered as a negative item. Why? Because it results in the outflow of foreign currency. The following are some of the major services. Number one, shipping service, insurance and banking services, income from investment, foreign travel, miscellaneous transactions such as royalty, consultancy services, telephone services, etc. Let us see the net balance. The net balance is also called balance of services. In the case of goods, it is called balance of trade, and in the case of services, it is called balance of services. Let us discuss the third components of current account, that is unilateral transfers. Unilateral transfer refers to the one-sided transfer such as gifts, donations, grants from foreign government, etc. A country makes such transfers to the rest of the world, as well as receive transfer from rest of the world. Mostly when the other country is facing the problem of drought, calamities, The Indian government donate money or donate goods and provide financial help. And when our country is facing the problem, we also receive donations, grants, financial assistance from the other country. The receipts of the unilateral transfers are recorded as a positive items in the current account of BOP. Why? Because it brings the unilateral transfer, and because it brings the money, foreign currency. Whereas when we give the money to the other country, it will be considered as a negative item. Why? Because there is an outflow of foreign currency. The net balance is called net transfer receipt. What is the net balance called? Net transfer receipt. Let us see the next component, that is income. Income is classified as investment income and compensation of employees. So if we have to classify the income, we can say income can be classified into two. That is income from the investment, and the income is related with the compensation of employees. Let us see the investment income. Investment income includes interest, dividends, etc. It is the outcome of the investment that we get. The next is compensation of employees. It is the factor income earned for rendering factor services. It includes salary, wages, bonus, allowances, perquisites, etc. The net balance is net income receipt. Now let us discuss the important next topic, that is capital account of balance of payment. Capital account refers to that account of BOP which records all the transactions that cause a change in the status of assets and liabilities of the government or any of the residents of a country. So the transaction having the effect on assets and liability of the government is called capital account transactions. Let us see the components of capital account. Following are the three major components of capital account of BOP. The first one is foreign direct investment and portfolio investment. Listen, foreign direct investment refers to the investment in the assets of a foreign country. Listen, when the foreign country made the investment in one country, then it is called foreign direct investment. This investment will be on the new project, and this investment may be related with the takeover of the domestic company, and this investment is always out of the stock exchange. It is not through the stock exchange, but it will be out of the stock exchange. When the investment is above 10% of the paid up capital of the company, it is called FDI, above 10%. And if the investment is below 10% of the paid up capital, then it is called foreign institutional investment. This foreign institutional investment is through the stock market. So when we are talking about the first component, it can be foreign direct investment or FII, foreign institutional investment, and the other one is portfolio investment. When I say portfolio investment, it means when the resident of the foreign country make investment in the stock market of the domestic country, then it is called for example, we can say when the foreigners invest the money in Indian stock market, I mean they purchase shares, debentures of the Indian stock market, it is called portfolio investment. When we are talking about the portfolio investment, the foreigners, they don't have any control on the assets and liability. But in the case of FDI, the foreigners are having the direct control on the assets and liabilities of the domestic country. The next component is loans and borrowings. Loans and borrowings by a country from the foreign countries or from the international money market are recorded in the capital account of BOP. These borrowings can be in the form of commercial borrowings. Listen, we are having two types of the borrowings. One is called the commercial borrowings and the other one is called assistance borrowing. When the money is being borrowed from the foreign country at the market price, it is called commercial borrowing. And when the money is being borrowed below the market price rate, it is called assistance borrowing. Normally, assistance borrowing is to provide help to the domestic developing country. So when a country borrow with the consideration of assistance, the transaction would involve low rate of interest as compared to the prevailing market rate of interest. That is called assistance borrowing. As against this, commercial borrowings involves open market rate of interest. It means market rate. Loans and borrowings results in the inflow of foreign exchange into the country. So when we borrow the money, money comes in the country and it will be considered as a positive item. Unlike FDI and portfolio investment, loans and borrowings are debt creating capital transactions. The next is banking capital transactions. Another form of capital account transactions are banking capital transaction. What it means? Such transaction refers to the transactions of the external financial assets and liabilities of the commercial banks and cooperative banks. It means bank having the branches in abroad, they have the financial assets and the liabilities, and they operate as authorized dealers in the foreign exchange market. Having branches in abroad, definitely they are earning, they have the investment in foreign countries, they might be having the assets in the foreign countries. Fine. So when they opened up the branch in abroad, they works at the authorized dealer in the foreign exchange market, and it is one of the components of the capital account transactions. That's all I have in this video. Thanks for watching. God bless you all. Dear subscribers, if you have not subscribed my channel, please subscribe the channel and don't forget to press the bell icon so that whenever I upload the new video, you get the notification.